Exemption from presenting consolidated financial statements. A parent is not required to present CFS if it meets all of the following four conditions. Condition number one, the parent is either a wholly owned subsidiary or a partially owned subsidiary of another entity. Further, its other owners, including those not entitled to vote, have been informed and do not object to the parent not presenting CFS. Condition number two, the equity instruments or the debt instruments of the parent are not traded in a public market. The public market could be domestic or foreign stock exchange or an over-the-counter market, including local and regional markets. Condition number three, the parent has neither filed nor is in the process of filing its financial statements with a Securities Commission or the other regulatory organization for the purpose of issuing any class of instruments in a public market. Condition number four, the ultimate or any intermediate parent produces financial statements that are available for public use and comply with Ind AS, in which subsidiaries are consolidated. Further, a parent who fulfills the following two conditions is also not required to present consolidated financial statements. Condition number one, the parent is an investment entity. Condition number two, the parent is required to measure all its subsidiaries at fair value through P&L account. What do you mean by investment entity? Investment entity is an entity obtains funds from investors for investment management services to those investors. An entity's business purpose is to invest funds solely for returns from capital appreciation, investment income, or both. Our entity measures and evaluates the performance of substantially all of its investments on a fair value basis. It should meet all the above elements to be qualified as an investment entity. For assessing investment entity, also consider the following four typical characteristics: whether it has more than one investment. In some cases, holding one investment does not prevent it from meeting definition if the entity. Definition of investment entity. Example, if it is in startup period. Whether it has more than one investor. In some cases, having one investor does not prevent the entity from meeting the definition of investment entity. Example, if it is within its initial offering period, an entity is still identifying a suitable investor. Whether its investors are not related parties of the entity. Having unrelated investors would make it less likely that the entity or other members of the group containing the entity would obtain benefits other than capital appreciation or investment income. However, an entity may still qualify as an investment entity even though its investors are related to the entity, whether it has ownership interest in the form of equity or similar interest. An entity that has significant ownership interest in the form of debt that may still qualify as an investment entity, provided that the debt holders are exposed to variable returns from changes in fair value of the entity's net assets. If it does not meet all the four typical characteristics, it may still be an investment entity based on the presumption of substance over form. Consolidation not required. An investment entity shall not consolidate its subsidiaries. Instead, it should measure its investment in subsidiary at fair value through P&L account in accordance with Ind AS 109. There are two exceptions to the above rule. An investment entity shall consolidate that subsidiary which provides services related to investment entities' investment activities. A parent of an investment entity shall consolidate all entities that it controls, including those controlled through an investment entity's subsidiary, unless the parent itself is an investment entity. For example, there is an entity A which is a parent of investment and it made investment in X Limited and investment in Y Limited. We need to consolidate investment entity A and subsidiaries controlled through investment entity A. Investment entity A not to prepare consolidated financial statements and measure its investments at fair value through P&L account, FVTPL. Accounting for change in investment entity status. A parent that either ceases to be an investment entity or becomes an investment entity shall account for the change in its status prospectively from the date at which the change in status occurred. Accounting when an entity ceases to be an investment entity. When an entity ceases to be an investment entity, it shall apply Ind AS 103 to any subsidiary that was previously measured at fair value through P&L account. The date of the change of status shall be deemed acquisition date. The fair value of the subsidiary at the deemed acquisition date shall represent the transfer deemed consideration when measuring any goodwill or gain on bargain purchase that arises from deemed acquisition. All subsidiaries shall be consolidated in accordance with the consolidation principles. Next, accounting when an entity becomes an investment entity. When an entity becomes an investment entity, it shall cease to consolidate its subsidiaries at the date of a change in status, except for any subsidiary that itself is not an investment entity but provides services related to investment entities' investment activities. Such subsidiaries shall be continued to be consolidated. The investment entity shall apply the requirements of loss of control explained earlier to those subsidiaries that it ceases to consolidate as if the investment entity had lost control of those subsidiaries at the date.